Hi and welcome to Penser Bank and our analyst presentation on Beijer Group. My name is Markus Almerud and I'm an analyst here at the bank. So Beijer Group is a leading manufacturer of routers, switches and industrial panels for demanding and harsh environments. We have a fair value range of 115 to 117 Swedish krona and the share is just below 100. We're here today to follow up after Q4 earnings and as the share has come back recently. Starting with Q4, order intake growth was negative for the first time since 2020 in the quarter, but it was all because of China, which slowed down in the fourth quarter. Europe was strong and North America was very strong. For the group, order intake was around or over 600 million krona for the fifth consecutive quarter, adding to the evidence that we have reached a new level. And given that China's manufacturing PMI has bounced back, and backed by anecdotal evidence, China seems to be recovering gradually. Sales was and will continue to be supported by the strong order book, and organic growth is still at high double-digit levels. Component shortage is still a problem. It's hampering both sales and earnings, but here again we hear anecdotes about the shortages abating overall generally in the market, which should allow for sales to accelerate further. And the high sales drove the margin. So the margin fell sequentially as it again had to buy components in the market, in the spot market, which dragged on earnings. But there are two things which are important here to mention. Firstly, the trend continued to improve. And secondly, were we to adjust for the extra cost incurred from these spot purchases, the margin would have been at the same level as the record high Q3. What does this mean? Well, it means that as the component shortages abate, we expect the growing sales to continue to drive the margin. And as we said before, anecdotal evidence points to these shortages easing. And was that to happen, the margin expansion should accelerate. So what does this all mean for the share? Well, 12-month forward PE is at 13 times, while the market is at 15. All trends are pointing in the right directions, even if Q4 was a bit of a setback in terms of margins. The trailing margin is at 10%, while the target is at 15%. So assuming that they will reach their targets, which we think they will, we're looking for double-digit EPS CAGR for the coming years. This is an earnings case with high exposure to rail and track as well as electricity infrastructure, and the multiples are attractive. Future looks bright. Thank you.